asset allocation across the portfolio. Now, there are 3 steps to form the portfolio. So the first one is asset allocation. Asset allocation is the choice among broad investment class, which means that you basically have this is about the risky portfolio. And for risky portfolio, like may have bond market, stock market, you may get the derivatives or similar like the real estate, things like that. You choose among those broad investment classes. Complete portfolios now you think about entire portfolio, including risk and risk-free asset. Okay, and the more important thing one is now if you form the risky asset portfolio, then you can mix risk-free asset to control the risk. So choice between risk and risk-free assets called capital allocation. So what is the risk-free asset? This is the risk-free asset you can use. The treasury bond, treasury bill is the risk-free asset, but T-bond is also maybe used as a risk-free asset since it's almost okay. But still affected by inflation, right? Because inflation does not, inflation may change the value of the treasury bond rate. So you may have another type of the treasury bond, government bond, price index government bond, which is adjusted by inflation. Money market instrument effectively risk-free. Many savings accounts, certificate of deposit, basically are risk-free since FDIC insured up to $200,000, individual $250,000 joint account. So that's for sure money, right? Risk of CD, again, certificate of deposits and commercial paper is very low. So you can use this type of asset as a risk-free asset because the problem is you cannot directly access to the T-bill. Now how to allocate the portfolio. So now this is the complete expected return of the complete portfolio, including the risky portfolio and the risk-free asset. This Y is the proportion, the weight for risky portfolio, right? So risky portfolio expected return plus 1 minus Y, which is the riskless portfolio, the risk-free asset proportions times the risk-free asset will be the expected return for the complete portfolio. So you have risk portfolio plus risk-free asset. If you want to take less risk, then you can increase this portion. If you want to take more risk, higher risk, then you can increase the risk portfolio portion. Now, standard deviation of the complete portfolio is simply the Y times standard deviation of portfolio because actually it's actually 1 plus Y times risk standard deviation plus actually 2 times Y, 1 minus Y, and standard impact actually if it's a square, and square, and standard deviation of the portfolio, standard deviation risk-free, and correlation and portfolio risk-free. That's actually the formula. However, the thing is, this is 0, so it's all gone. So the variance of the complete portfolio is simply the Y squared times portfolio standard deviation. So simply, you see, we have this formula. So this is the kind of beauty of the risk-free asset. If you add risk-free asset, you can still have some values, expected return from the risk-free rate, but you can actually limit a substantial amount of the risk. So this is very good way to reduce the risk substantially. Now this is the investment opportunity set. So in equilibrium, this is a risk-free asset. and this is the standard deviation, right? So 0 standard deviation means no risk. That's the risk-free asset. If the portfolio standard deviation is 22% now, you have this opportunity set, and this is expected return is 15% now. You have 50% risk asset. So 50 risky and 50 risk free. Then you have this opportunity set. You can increase the proportion of the risky asset, then you can expect higher returns. If you reduce the amount of the risky asset, again the Y decrease. Oh, by the way, this is y equal to 1, and this point is y equals to 50%. This point is y equals 1.25, which means that the risk asset is 125%, so you short 25% risk free. So you can have actually negative proportion by shorting. And this line called capital asset allocation line. So that's the capital allocation, right? Capital allocation again is to determine how much risk-free asset, how much risk portfolio you allocate, right? Based on that, this is when y equals to 1, and this is when y equals to 50%, so 50-50, and this is 125% y, the risk asset, and negative 25% risk-free asset. And this amount is risk premium. So risk premium changes based on your position, right? Now capital allocation line is the plot of risk return combination, right? So now if we believe this A is the amount of risk aversion, so if you are more risk averse, then A is higher. It means that if A is higher, what happened? If A is higher, then your Y, the proportion of risk asset actually decrease, right? So the proportion of risk asset is available risk premium to variance ratio, which is the risk premium divided by portfolio variance, which is the price of the risk of the portfolio. So this is the price of the risk portfolio, right? Divided by A, which is the risk aversion. So if A is higher, you decrease the proportion of risk asset. If A is lower, you increase the proportion of the risk asset. And you can rewrite this. This is the risk premium of expected return times 8 times variance of the portfolio. That may be the good measure of the good measure to find the proportion of the risk asset when you do the capital allocation, right? Again, if you are more risk averse, so it means that you don't want to take risk, then you decrease the proportion of the risk asset, vice versa. Now, if you look at the capital market line, there's kinds of good one good lessons you can learn actually. First of all, you remember last class, the active strategy versus passive strategy, right? Active strategy, they try to find a mispriced asset and trade, right? So it's priced procedure, but you can make more money. Passive strategy, we just leave it. So you take just the market return. So we don't do security analysis if you just pick the passive strategy. It means that you just follow the capital market line, this capital allocation line, using market index portfolio as risk asset. So this is if you just pick S&P 500 and you draw the capital market line and you just change the proportion of this S&P 500 index funds versus the risk-free funds, So if you want to take same level of the risk as market and y equals to 1, right? You can increase or decrease and just move here. Then you don't do many things, just that you don't have to do the security analysis. And that's the benefit of this strategy. Is now there's a cost and benefit. The biggest benefit for the passive strategy is easy, it's simple, inexpensive. You just pick the capital allocation between the risk asset and index funds, market funds. So usually the cost is not that high because you may lose some opportunity, like for active investment. The cost of the active investment is about 1%. Expense ratio of active mutual fund average 1% means that you have to pay about 1% as a cost for active management, like active strategy, to do security analysis. Now, expense ratio of hedge fund average. Hedge fund is more aggressively find the mispriced one, 1 to 2% plus 10% return above the risk-free rate. It means that, well, they basically try to find mispriced one, but they also aggressively find that, so that they spend more money, they make a little bit more money than the passive strategy or just a normal active strategy. So the thing is, now you pay 1% every year if you take 30 years investment. The cost is now 1.10 part of 30, which is 17.45%. So it's actually 17 times more. Just 1% differences, right? It means that it's because of compounding. So the cost 1% is not ignorable. Sometimes you need to actually have a lot of returns, a lot higher returns, to do active strategy. So that's the benefit for passive strategy. The cost, you don't have to pay a lot of cost. Still, your return is not that low. It's easy, simple. However, there's also the benefit of active management because it actually gives the potential for higher returns. So we're gonna learn that in later chapters, how to do security analysis. Why the security analysis gives us the abnormal returns. Because people pay for that active strategy too. So that's your choice. You can choose the passive one, just a market portfolio versus a risk-free asset. So the easiest way is that you hold the S&P 500 mutual fund plus some cash. If you want to take less risk, then you increase the cash. If you take higher risk, then you decrease the cash, right? And increase the market fund, the S&P 500 mutual fund. Or you can also pick the active strategy and do security analysis, pay about 1%, Still, if you can make more money, then it's okay. It's possible that you may lose one because the cost is not that low, right? So this is the end of chapter 5.